We are covering these 6 top big cap stocks with large percentage moves today. While watching bullish price actions, let us inform you. Our review on IRBT. iRobot, the company behind the iconic Roomba, has had a pretty rough ride lately. Known for revolutionizing home cleaning with its robots, the company is now facing some serious challenges. Recently, iRobot's stock tanked over 30% after it admitted it wasn't sure about its ability to stay in business. The trouble really started when Amazon pulled out of its $1.7 billion acquisition offer earlier this year, mainly due to regulatory issues. Since then, iRobot has been struggling to keep the wheels turning, dealing with cash flow problems and mounting debt. To try and turn things around, iRobot has been restructuring, even laying off over half of its workforce. It's also launched a bunch of new Roombas, hoping to regain some market momentum. But despite all these moves, the company is still facing tough odds, limited consumer interest, stiff competition, and even uncertainty around tariffs. For Q4, iRobot's revenue fell a steep 44% year-over-year, coming in at $172 million, missing expectations by a wide margin. On top of that, it posted a significant loss of $77.1 million. With all these issues stacking up, it's tough to say what's next for iRobot. While they're clearly trying to innovate and stay competitive, the uncertainty around their future has left investors uneasy. It's a situation worth watching, as the next few months could be make or break for the company. Our review on SMTC. Semtech Corporation, known for its high-performance semiconductors and IoT solutions, had a big day recently, with its stock jumping nearly 21% after releasing better-than-expected fourth-quarter results. The company reported earnings of 40 cents per share, beating analyst expectations by 25%, and posted revenue of $251 million, edging past the $249 million estimate and showing a solid jump from last year. What really caught investors' attention was the strong earnings and the fact that Semtech managed to reduce its inventory levels, signaling improved operational efficiency. Despite these positive results, the company's guidance for the next quarter didn't meet expectations, which tempered the excitement a bit. Still, the sharp jump in its stock shows that the market's been paying close attention to Semtech's performance and sees potential in its business. The semiconductor sector, including Semtech, has been volatile lately, with the company's shares moving up or down significantly multiple times this year. This kind of swing, like the 19.4% increase on the back of these earnings, is rare for Semtech, highlighting just how much impact this news had on investor sentiment. Even though the stock is still down more than 36% since the beginning of the year and trading almost 50% lower than its 52-week high, these recent results suggest that the company is making strides in a tough market. For long-term investors, the performance has been solid, with a 46% return over the past 5 years, which, while not earth-shattering, shows steady growth. Whether this rally signals a true turnaround for Semtech will depend on how they manage to meet future expectations. Our review on CDLX. Cardlytics is a digital advertising platform that partners with financial institutions to help marketers target their customers more effectively through their banking apps. They've had a rough year, though, with their latest report showing a 10% drop in revenue compared to last year. This decline was partly due to offering more consumer incentives, which reduced their reported revenue. They also saw a decrease in both gross profit and adjusted EBITDA, and their net loss grew significantly, largely because of a big write-off related to their bridge platform. On the bright side, Cardlytics still has strong relationships with banks and a solid data-driven approach that makes purchase data actionable for advertisers. Their ability to tap into consumer spending patterns is a unique strength. However, they're facing challenges like ongoing operating losses, negative cash flow, and the need to keep securing external funding. Additionally, the company's growth hinges on successfully integrating the Bridge platform, which hasn't gone as smoothly as hoped, as seen with the recent impairment charges. Looking ahead, Cardlytics is exposed to risks like economic downturns, competition from other ad tech firms, and potential regulatory changes. Despite these hurdles, the company is still investing in growth, especially through expanding partnerships and improving its analytics capabilities. While the road ahead may be rocky, Cardlytics' position in the commerce media space could set them up for recovery if they can tackle these challenges effectively. Investors should keep an eye on how well the company navigates these issues in the coming months. Our review on SNBR. Sleep Number Corporation, known for its innovative wellness technology, is once again making headlines with a major shift in its corporate structure. As a company that designs and manufactures cutting-edge sleep solutions, including its smart beds with individualized temperature control, Sleep Number has long been at the forefront of improving sleep health. Their smart bed ecosystem is built around personalization, offering unmatched comfort and temperature balancing, which has positioned them as leaders in the sleep wellness space. Now, Sleep Number is entering a new phase with a recent agreement with one of its shareholders, Stadium Capital Management. This deal is marking a significant turning point for the company, as it comes with the retirement of 5 current members from the Sleep Number Board of Directors. This is a big change for the company, and it could signal new directions or shifts in their strategies moving forward. In exchange for these board retirements, Stadium Capital has agreed to withdraw its previous director nominations and will now vote all of its shares in favor of Sleep Number's nominees at the 2025 annual meeting. This move could be a sign that both parties are aligning for the company's future, with a potential focus on stability and growth. For investors, this is one of those moments to watch closely, as changes at the board level can sometimes lead to strategic shifts that impact the company's direction. With Sleep Number working to maintain its leadership in the wellness tech space, these adjustments to the board could bring fresh perspectives, and it'll be interesting to see how this plays out as we head into 2025. Our review on PLPC. Preformed Line Products Company is a global leader in designing and manufacturing products for the construction and maintenance of overhead, ground-mounted and underground networks in energy, telecommunication, cable, and data industries. Their diverse range of products includes formed wire solutions connectors, splice closures for fiber optics and copper, solar hardware, and electric vehicle charging station foundations. In their annual report for the fiscal year ended December 31st, 2024, the company reported net sales of $1.23 billion, marking a 4.5% increase from the previous year. However, net income took a hit, decreasing by 10.3% to $43.1 million. Along with this, their gross profit margin slipped from 25.3% to 24.1%, while operating expenses rose by 5.1%. Their cash and cash equivalents also fell to $143.1 million, and the company saw an increase in debt, reaching $243.1 million. PLPC operates across 20 countries, divided into 4 key geographic segments: PLPUSA, the Americas, EMEA, Europe, Middle East and Africa, and Asia Pacific, each supporting a range of products. While their revenue growth is a positive sign, the decline in profitability and increasing expenses are factors that investors should monitor closely. The rising debt and cash flow challenges may pose risks, but with a diversified global presence, the company still holds potential if it can stabilize its operations and manage its costs more efficiently moving forward. Our review on PD. PagerDuty Incorporated is a digital operations management platform that helps businesses handle urgent, mission-critical work by leveraging data and machine learning. Its offerings, including incident management, AIOps, and process automation, ensure that the right people have the right information to act quickly. Recently, PagerDuty set a revenue target of $500 million to $507 million for FY 2026, expecting 7% to 8% growth. However, analysts are mixed, with many lowering their price targets. The average 12-month target is now $21.40, down from $24.40, reflecting concerns about the company's growth. Goldman Sachs, RBC Capital, and other analysts have downgraded their ratings, with price targets ranging from $18 to $26. While PagerDuty's platform continues to show growth potential, especially in incident management and automation, its stock is facing some challenges. The lowered price targets and mixed analyst sentiment suggest that investors should stay cautious as the company navigates market conditions and works toward meeting its growth goals. Please subscribe, give the video a like, and watch more from our playlist. Thanks.